This Angel One investment presentation is brought to you through the generous support of our exclusive sponsor, Deloitte, our platinum sponsors, Simpson Weigel Law, Positive Venture Group, Cleveland Clinic Canada, and Plaza Ventures, and our gold sponsor, Owens Wright, LLP.
Thank you, Karen. For those of you that don't know me, I'm Larry Ennin. I'm a recovering lawyer and a serial, hi Chris, a serial angel investor who dropped out of Angel One about 3 years ago because I promised my wife that I'd never invest again and would simply harvest the investments that I'd made.
See how well that worked.
And then I met my next door neighbor. So it's quite an interesting story. I won't bore you with it except to say that Reuben was beside me for a year. We'd said exactly 6 words to each other. Our wives and knew each other and we knew their kids, but Reuben was very, very shy. So you'll find him shy again today. Anyway, we discovered about 3 weeks ago that we're both angel investors, and we've been sort of going like a house of fire since then. So Reuben, Randy, and Tanner have agreed to act as a panel, and I've pre-circulated to them my sort of dummy questions, because I'm very much a dummy in the cryptocurrency world, although courtesy of Tanner, I now own kin. So thank you, Tanner. Came to my house, set me up, and just sent me my certificate yesterday, so we're all good. In any event, the idea would be that this should be interactive. So we want to hear your questions. Feel free to interrupt myself or the panel at any particular point. The objective is to learn something here today. If we go away with 3 new things in our heads, I think we can consider it to be a success. So the first hour, we'll proceed with the questions that I've laid out. Are there any questions before I start? Okay. So the first question, I don't know who's the magic turner of the slides. Do we have one?
Do you have the clicker in front of you?
I probably do, but I don't see it.
Well, that could be because it's the
Where do I point it?
nowhere. Just click on the left.
Click on the left? Okay.
There you go.
Okay, so question 1. This is for the panel. When did you first become interested in cryptocurrencies and why?
Yeah, so I actually first kind of found cryptocurrencies, became infatuated with it in 2013.
You want to grab your mic?
Oh, I thought we were using these.
Yeah,
ones.
it's a double mic.
Oh, double mic, okay. Yeah, so 2013, I actually wrote a paper on Bitcoin for a finance class and just became enamored with the blockchain space, as well as some of the things that cryptocurrency was doing, and was kind of passively involved for a few years, more on an academic basis. And then this past year at Kik, we started developing Kin and have been pretty much living and breathing cryptocurrency since then.
Want to go or?
Yeah, sure, go ahead.
Okay, go. Hi, I'm Reuben, co-founder of CoinLaunch. You know, my entry into the space of cryptocurrency began actually with the company I founded in 2003, Anomaly. The initial view of that company was to treat computing resources as a kind of utility. We looked at it from a financial model and used it as sort of a metered basis. In 2009, I created a product called SpotCloud, which essentially allowed it to we treated compute resources that were decentralized and distributed around the globe as basically a commodity, a sort of something similar you'd see on like the Chicago Mercantile Exchange. So we were able to trade that compute as a derivative. And we actually worked with the Chicago Mercantile Exchange, the NASDAQ, ICE, and a few other exchanges in an attempt to basically use computing resources as a utility. To do that, what we were missing, this is 2009, was the component blockchain, which we didn't put in. We used more traditional approaches at the time. So later in 2011, Bitcoin started sort of breaking out, and I bought Bitcoin based on a bet I had made with the editor of the MIT Technology Review magazine. I lost the bet, and as part of that bet, essentially I owed him 15 Bitcoins. And buying a Bitcoin in 2011 was a real pain. So I had to do a Western Union wire to this outfit in Japan, which ultimately I think went bankrupt, this Mt. Gox company. Anyway, so being that if I'm going to buy 15 Bitcoin, which was worth probably about $15 at the time, I figured I'd make it worth my while. And so I bought about $10,000 worth of Bitcoin at that time. And from 2011 to 2014, it went from a couple bucks to $1,200. I'm like, it's no way it's going to go beyond $1,200. So in 2014, I exited all my holdings and said, I've done 10,000% or something crazy like that. Well, it kept going up, but there was a drop actually, later in 2014. But so I counted my sort of blessings and moved on. Last year, I think it was roughly about a year ago right now, I got back into cryptocurrencies, buying what they call altcoins. These are things sort of alternative to Bitcoin. And again, timing was impeccable. And Randy and I sort of have been jointly investing in a variety of cryptocurrencies, real estate, and related activities. And the cryptocurrencies went up 4,500% over the last nine months. So that's how we got into it. I know it's a long story, but that's our involvement.
I'll keep my tale a little shorter. My journey into cryptocurrency is a little more traditional. Embarrassingly enough, as a technology individual, I first started looking at cryptocurrency about 3 years ago after selling my previous company. As an entrepreneur, investor, real estate investor, I saw huge potential for using cryptocurrency as a vehicle to solve fractional ownership, trustless mechanisms to solve liquidity and to unlock income potential around latent, kind of dormant assets. So think real estate, art, things like that. So, that's started off my journey and exploration to cryptocurrency. And Reuven and I were investing in real estate, and that journey led into the creation of CoinLaunch.
So this question is for the audience. Karen Stoll had asked it before, but by a show of hands, how many of you currently own a cryptocurrency? 1, 2, 3, 4. Keep your hands up, please. 6, 7, 8 people. Okay. And now, this will show you how technologically savvy I am. By a show of hands only, how long have you owned a cryptocurrency? Less than 6 months? 1 year? Oh, wow. Okay, so we're all newbies. Next question for the panel is a question that I've been asking and haven't been able to answer yet. What is a cryptocurrency?
Sure, yeah, I can take it. Yes, I think, to start, I think it's important to set context as to like, what is a currency? And I would say, common definition of a currency is a unit of account, a store of value, or a medium of exchange. So cryptocurrency, the first one was Bitcoin, leveraging the blockchain, which I believe we'll probably talk about a little bit in more depth, but essentially a cryptocurrency guarantees the state of an economy, whether that's the current supply, who has that, who currently owns part of that supply, and also who has owned it in it previously. And that's all tracked through a public ledger called the blockchain. And the reason we call it cryptocurrency is that being that it is public, it's also pseudo-anonymous through cryptography, so that you can have something public which guarantees kind of the state, and that's how the state of an economy is guaranteed. But given that you are putting something public, it leverages cryptography in order to keep it secure, so that there is still a level of security. Anything to add?
You want me to jump? So I'll jump in. Kind of my answer is a little bit convoluted, and there again, as you jump into the space, you'll have different analogies and ways of looking at it. So number one, a lot of people think about how do you understand cryptocurrency? If you think about Napster, that would be, a peer-to-peer network, right? So that's an element of cryptocurrency. So as Tanner mentioned, in terms of currency in general, cryptocurrency is a medium of exchange created and stored electronically, hence being crypto, in the blockchain using encryption techniques to control the creation of monetary units and the verification of the transfer of funds. So that would be kind of a technical definition. If you look at all the elements of cryptocurrency, the main element would be that it's peer-to-peer. So think of a decentralized clearing. So unlike typical currencies that are controlled and regulated by banks and government, cryptocurrency is peer-to-peer. So you've got, when transactions occur, they are requested and verified throughout the entire network. So think of peer-to-peer, decentralized, and trustless. And secure. And they're secure if you look at the evolution of accounting, based on the general ledger, then you've got the dual ledger. Cryptocurrency is a multiple ledger. So you've got, no one repository is creating that trust. It's not a bank, a government organization. So that's a lot of the appeal to cryptocurrency. And if you think of the attributes about it, I think of it as what you call FIPS. So fast and global. So hence some of the momentum around cryptocurrency. It's irreversible, which is good and bad. So, if you lose your wallet, it's gone, right? So, but it's irreversible in terms of its atomic contract. Permissionless, there again, not relying on any type of bank or clearing or settlement. Synonymous and secure.
What he said. Okay.
Okay, here we go. Why, in your opinion, has it attracted so much interest?
The obvious ones, when you hear me say, we've made 4,500% in the last 9 months. I think that people are starting to hear about this, and that may not necessarily be a good thing. There's certainly a speculative aspect to it, which I think is a short-term opportunity. I don't even know I'd even consider it an opportunity. I'd probably consider it more of a risk, easy up, easy down. But unfortunately, that is probably right now a big driver. I think in terms of what we see this transformation away from sort of traditional paper money to one that is more crypto and digitally centric. So when we look out, 10 years or even further, we don't see paper money being the primary mechanism of value creation and value transfer. And so what we look at as cryptocurrency as being a key enabler of this sort of new mechanism to generate value in a digital world. So if you're Kik, for example, or any other company looking to generate value, what says that a dollar or a traditional piece of money is going to be the primary mechanism that you use to generate value in your business? So I think that sort of view is starting to propagate around different companies, startups, and people who are basically fans of this type of currency.
Yeah, I would tend to agree. I think we've seen some large gains as of late, and part of that is just rolling thunder that you see in press and speculation. But I think ultimately there is an underlying value, and the reason that I'm a firm believer that there is a long tail of value here is that if you look at the history of transactions, and as was mentioned, the kind of the unique value proposition is a decentralized peer-to-peer trustless network. And by trustless, I mean like not needing trust. And I think a reason that we're going to see this continue on for, in perpetuity, I believe, is that for the longest time, a lot of transactions, if you look in human history, were face-to-face. If we're making a trade or with paper money, I'm buying something off you, so we show up and we make that transaction. And now, in this age of globalization, a lot of these transactions that we're having, you're not actually even ever meeting the person. So there's an enhanced amount of trust. And we've also seen whole asset classes that originate and live in the digital space. So there's not actually a physical asset. So actually transferring paper money or fiat currency is starting to become more of an issue from a trust perspective. So you need an opportunity to transact and remit value without the need for trust, and cryptocurrency is an opportunity to do that. Also, we have all these digital assets that are now creating immense value. You need a digital currency to be able to actually facilitate that value exchange. So cryptocurrency solves this fundamental issue of the trust issue in the exchange of value. And I think the reason that we're also seeing it start to come to fruition now is a big reason why Bitcoin was started 9-10 years ago is there's a fundamental lack of trust in centralized entities. You see that across the globe, and there's a need for a change where you don't have a centralized clearinghouse where you're relying on the centralized entity. And an example of that is like hyperinflation. And one of the things that a cryptocurrency does is guarantees the scarcity of an asset. A government can't overnight print twice as much money in the context of a cryptocurrency because there is a public ledger that's decentralizing. You understand that there is a scarcity of an asset there.
Great. I would from a practical point of view, look at four main things. Tanner mentioned globalization. So if you look at real estate, right? Real estate all over the world is skyrocketed in the last 5 years, 4 years, 2 years. And that's as a result of, you've got emerging markets, you've got, the world is becoming more connected, more global. So you've got capital flows that are just moving freely, looking for more efficient regimes, economies, taxation, what have you, right? So if you look at, in particular, Canada's been a big benefactor of that in our real estate economy. People might have different opinions on why, in terms of, we're fairly open, we're not tracking, money flows, stuff like that. So, you could almost say cryptocurrencies, real estate 3.0 or Canadian real estate 3.0. So, it's facilitating the global move of capital. So that would be number one. Number two, it's the new asset class. So like any new asset class, you've got a lot of hype and speculation and attention. I suspect a lot of people jumping into cryptocurrency, don't really fully understand it, but they've seen, as Reuven mentioned, the huge gains, the opportunity. So you've got a lot of, high net worth investors that are saying, well, am I going to put all my portfolio there? No. 50%, 20%, 3 to 5%? Sure. Right? So, small risk in terms of overall percentage of your portfolio, but big reward. The other thing would be a lot of people liken cryptocurrency to the internet. So it's one of the biggest technological innovations since the internet. So I recall back to the early 90s, people talking about the internet and email and all those features. And, you would talk to, lawyers, accountants, doctors, like, no, I just prefer to send that via fax instead of email, right? So cryptocurrency is kind of we're at that same wave, early stage, and having, most people having lived through that, missed out on opportunities and say, wow, what was I thinking? A lot of people are jumping in early because they don't want to make that mistake again. You could also say cryptocurrency is one of the greatest financial inventions, since the dawn of banking and derivatives, making anything liquid potentially, making anything fractional. So it solves a lot of very, 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 very big problems. So, you look at those issues in addition to, like Tanner mentioned, trust. If you look at the emergence of the global, emerging markets and global economy, there's a lot of places that don't have the luxury of a stable banking system, a stable regime, stable regulation, and the cryptocurrency actually does solve that. So despite what Western nations might feel that it's very volatile and fluctuating, compared to emerging nations where they've got much more volatility, it's something they can trust. So I think that's fueling the growth of cryptocurrency.
I'd add one more thing to this. As a developer, one of the things that cryptocurrency does, unlike regular currency, you pull out a $20 bill and look at it, you have no idea that's ever been spent on. If you look at a ledger within the context of a cryptocurrency, you can see the entire history of the transactions that have occurred within the context of that sort of currency. So, in terms of, we look at it as sort of anonymous or pseudo-anonymous, but it actually in some ways is less, anonymous than that $20 bill in your pocket. which is one, not programmatic. I can't develop against the money that sits in my pocket at all. It's a piece of paper. What's the difference between a $5 bill and a $20 bill? The color, I guess. It's certainly not worth more than the $20 bill, other than the value, I guess, we place on that color. And cryptocurrency provides, again, from a development point of view, the ability for me to do things with it that would be not possible in the context of traditional currencies. And I think that as a technologist, that's what's exciting to me. I can dream up new, innovative ways to use these things that may not even have to do with money in the traditional sense. And that's really exciting. And as these guys have mentioned, it's a brand new world. It's like the internet circa 1994. And the things that we'll dream up with it are completely unknown. The challenges are many, but the opportunities are even more plentiful. So.
Next question for the panel. What significance does it have for angel investors and their investee companies?
No, sure.
Sorry to dominate here, but Randy and I have done quite a bit of angel investing as well. For a while, I ran a technology accelerator in Menlo Park, California. It was basically we were an enterprise focused, doing deals. And the one thing that I think that cryptocurrency adds for angel investors is, again, this sort of tracking mechanism. It provides a contractual obligation. When you invest in a startup, you're basically getting a contract. So the interesting about angel investing and cryptocurrency is now this contract doesn't necessarily have to exist just in the form of a piece of paper that sits in a PDF on your hard drive, but now it can sit as an atomic component. Once this contract's been agreed to, let's say it's a SAFE, or in our case what they call a SAFT, a simple agreement for future tokens. The contract is uneditable. Meaning that once it's been deployed against a blockchain, you can't go and change the rules, or I forgot about this little clause, or it is what it is. So if you agree to a component, on a blockchain-based contract, and the certain criteria get executed upon, it happens. Whether that's liquidity, which happens much more quickly in the case of a token, if someone's going to do an ICO, rather than waiting, years potentially, the ICO could actually happen quite quickly. So your path to liquidity could literally be days or months rather than multiple years. And again, the terms of that contract, again, this is what they call a smart contract, is specific and uneditable. So if the contract states that you get liquidity at a certain point, let's say it's a SAFE agreement, which you're probably familiar as angel investments, and the SAFE agreement essentially is a equity that's being offered based on a future valuation. That valuation can happen not on an IPO or an exit, but can happen on the point of which time something else may occur. In this case, maybe an ICO that says that X amount of money is raised, and then there's some basic criteria for what the value of the company or equity is based on that. So there's a lot more options, it's a lot more liquid, and a lot more flexible.
Yeah, I think those are all really interesting and valuable points for sure. I think around even just on a project-by-project basis as an angel investor, there's obviously a lot of attention being drawn to the industry, and a lot more projects are being spawned. I think there was 120 or so in August, just more prominent ICOs and a lot of other projects that are not necessarily ICO based, but also involved in the cryptocurrency space. And this is a burgeoning market, and as was mentioned before, it does kind of feel, I was really young at the time, but from everything I can read, was very much like the internet, in the mid to early, late 90s. And I think there's a serious opportunity to get in kind of on the ground floor of some really interesting innovation that's happening. I will also say though that it's not a can't miss scenario, as we saw at the crash of the internet bubble. There will be a correction and there will be a consolidation of a lot of these projects that are happening, but Amazon and Google and some of those came out of this, and I think there's a serious opportunity to be involved in kind of this next wave of computing, and people are kind of hearkening it to Web 3.0. But I would just say that there will be, in my opinion, I think the opinion of a lot of people, will be a formalization of the market and a bit of a consolidation. because there has been so much attention drawn, and a lot of people are trying to kind of capture the initial value of a lot of these sales. But I think the biggest thing to look at is the underlying value and what does this token actually empower, and what's the ecosystem that it's driving.
I'll start off with kind of just restating the question. The significance does it have for angel investors and the investee companies? So kind of to reiterate a lot of the points mentioned here, but to summarize it, we've talked about liquidity. So, now you actually have a potentially tradable unit. So, typically as angel investors, when you invest in a private company, you have no liquidity. So until the company actually makes money, pays a dividend, or actually does an IPO, right? There's no liquidity there. So the duration and the term has typically been much longer. So you've got liquidity issues or opportunities. Another point that I would bring up would be access. So typically, and as an investor, as an entrepreneur, access is a big problem for everybody. So, the potential to disrupt, larger traditional venture capitalists is huge. That's why everybody's jumping into the ICO space. So, as an investor, I belong to a number of different groups, and we go to groups and even, banking, and I'm a member of a private banking group. All the people in the room are curious, at the breakaway, at the coffee, what are you investing in? Let's trade deal flow. So, having a digital offering, having, the technology that we have now, having all that information at your fingertips, you've really created a new marketplace. So think of Amazon, right? You're bringing buyers and sellers together. So the sellers are the private, startups or private investments. So they're the issuers, and then the angels are the investors or the buyers. So that's a huge opportunity to create that open marketplace, democratizing investing, and so that would be liquidity, access. I would say governance. So kind of talking about what Reuven mentioned. In a sense, you've got a smart contract, so nobody has to dig through. It's transparent. It's easily adhered to. And then the other thing would be lower cost of ownership. So if you think of your traditional startup, when they go to raise a particular dollar figure of money, they have to comply with a lot of regulation. There's a lot of filings and whatnot. Not to take away anything from that, but as you know, if you've invested in a private company, all those protections, they don't really protect you from the company failing. Right, so some would argue that there's maybe maybe they're not as efficient as they could be. So I would say lower cost of ownership, governance, access, and liquidity.
Next question for the panel. What is the future of cryptocurrency in your opinion, and why?
Sure, yeah. Yeah, so I think we kind of talked about it a little bit before about why is there an underlying value here, and we're starting to see in this age of globalization, there's a lot more movement of value, and I think there's a serious need for a secure, safe digital currency to facilitate that. What's also interesting is we talked about the lack that a lot of people don't have access to the type of banking that we do, and there is a serious lack of trust with some of these centralized entities. It's actually interesting, like Visa published a study that they estimate there's about 2.5 billion people that are just completely unbanked or financially underserved. And what that means is that about a third of the world doesn't have access. Like as we're moving forward with globalization, they're limited to all their transactions basically being face-to-face, peer-to-peer. And that's almost 5 billion transactions per day. So I think what's a really interesting value proposition here, and what gets me so excited about it is an opportunity to bring a third of the world into this age of globalization and be able to transact on the global scale in a safe, secure way, and being able to facilitate these bilateral transactions where you're not relying on a centralized clearinghouse. I think the future is bright here as an underlying asset class because it has such firm underlying value. And as we start to see the globe start to bring in more and more innovation, it not only brings that third into the conversation, be able to participate, But that's a third of the world that right now we're untapped and not being able to exchange value with. So that's one of the things that gets me kind of really excited about it.
I would agree with all of that. One of the things that I think is driving is well, first of all, just a disclaimer, what we offer isn't a security. It's an asset, but just looking forward beyond sort of that disclaimer, the opportunities, in my opinion, derivatives. If you look at the derivative markets, they're basically contractual obligations between two parties. And the derivative markets represent several $1 trillion worth of assets that are essentially illiquid and require quite a bit of, there's clearinghouses. It's limited in terms of who can gain access to it. Generally speaking, the largest and best position can have the best position to benefit from it. What I think that cryptocurrencies and related technologies will enable is, again, this is a word that's thrown around a lot, democratization, easy access, broader access to things such as derivatives. It provides a mechanism to unlock liquidity within the derivatives market, and these could be simple derivatives. It could be let's say back to the Chicago Mercantile Exchange, just as an example. You look at a pork belly future. Why is that done in the form of a paper contract, or why is that limited to a certain group of accredited traders? Those sorts of things don't necessarily have to happen in the way that they happen. So once these technologies are applied to traditional financial markets, in particular the derivatives markets, you're going to look at a huge opportunity when we're talking trillions of dollars of assets that are now freely available to be defined in new and amazing ways. And let's just take that and put a discount on the illiquidity of those assets. I think what was the common number is about 20 to 30% in terms of a discount based on the illiquidity. So if you add if you look at, let's just say conservatively, a 20% discount on the illiquidity of those assets on a $10 trillion market segment, that's a huge amount of value that's being sitting locked up. So we don't need to have 20% of $10 trillion. I'd be happy with 1%, which is still what, $200 billion or something. So, those are the kind of numbers we're looking at. And if you can figure out little ways to unlock massive amounts of value, you're going to do extremely well.
Touching on the points that Reuven and Tanner made, and there again, all disclosure here, being a co-founder of a ICO, platform, I would say the future of cryptocurrency would be that currently, right now, investors look at cryptocurrency and say, well, I'm kind of intrigued, but it looks risky. I'm not sure. I think in the future, investors will look at any private investment, say, I'm not going to do it unless it's in the form of a token. They're going to want that liquidity, they're going to want that asset, they're going to want that smart contract. It's going to provide a lot of security and basically protection to investors. So I think the way of the future is, looking at, not just a currency, but as unlocking a store of value and allowing, typically private assets to become public. So that's kind of my future. There again, aggressive view that all assets, will be able to become commoditized through cryptocurrencies. But big picture, I think ICOs will give Silicon Valley and Wall Street a run for their money. It's opening access, it's democratizing cryptocurrency. If we look at the world becoming more and more global, cryptocurrencies will become the new global currency. So, more and more when companies are having to convert from, multiple currencies, why not just have one global currency? The speculation that we're seeing right now, I think will eventually, kind of slow down. Regulation will stick. Which might be counter to some of the people that are advocating cryptocurrency, but for it to become more mainstream, which it will, there will be some basic KYC and AML. So that's kind of my future view in cryptocurrency. It's here to stay. It's going to be more secure. more regulated, and it's going to be part of everybody's lives, and basically allowing investors to participate in typical assets that we're not able to participate in. So think of art, think of commercial real estate. So anything that's illiquid, that, as Reuven mentioned, typically trades at a discount. It'll trade as its current value.
I have a question.
Yes, ma'am.
So, one of the issues recently is China has decided that cryptocurrency can't be used in China, and there was an impact on the marketplace, wasn't there? Can you talk about that a little bit?
They're restating their regulations, which probably needed to happen there. They're basically going to regulate the cryptocurrency market, and one of the things that the Chinese, if you're familiar with Bitcoin in particular, they actually handle a large portion of the transactional volume of Bitcoin through cheap and easy access to energy. So what they're looking to do is have better, tighter controls over that. They haven't necessarily banned it at this point, but they've sort of pulled back in terms of the freewheeling Wild West of economy that they had previous. So I think it's an indication that compliance and regulatory oversight will be a fact of this industry, and it's something that we've actually taken into consideration, and we see that as actually an opportunity. Once you have a regulatory oversight, that actually will, I think, encourage the larger players to get involved. And you can't have the Wild West when you're talking billions or potentially more at stake. You need to have some level of governance in place. I don't think what they're doing is necessarily a bad thing.
Question. The immutable record you'll speak about, is that held by all the miners, or every single person has a wallet, has a copy of the ledger?
Every node on the network.
So everyone who's mining? Or
Yeah.
Once they've been verified by the miners, then it gets published to all the nodes instantaneously.
Who's a node? Is a node a wallet, or?
Node would be any computer on the network that's managing transactions.
Yeah, and just to just gonna add to that, the reason that you would say like it's immutable and you have all these nodes, like for example in the case of Bitcoin, it's about 12 minutes every new block is created, and right now there's about 10,000 nodes globally for Bitcoin. So every 12 minutes, a new block is uploaded to all these nodes, decentralized across the world. You can see, you can see a heat map of it if you just Google Bitcoin nodes map, I believe. You can see it's all over the globe. So every 12 minutes, you have this new record. So if you actually wanted to change the actual state of the economy, whether that's previous iterations of the blockchain, because every new block also has, through the Merkle tree, a cryptographic hash that references the entire history of the economy. So basically every 12 minutes you have a new ledger that has, from the beginning of Bitcoin all the way to now, all the transactions have happened or a derivative of that. So every 12 minutes that's uploaded to 10,000 nodes across the world.
Okay. And then the process of creating more coin, like for a currency, is driven by what the it's kind of backed by the economy in essence, right? So more currency gets created as there's more economic activity. How is that reflected in the mining process? It sounds kind of random that just mining creates more coin. There's no reflection of the underlying commerce.
So in the case of Bitcoin, it's not actually that they're creating more coin. There's a scarce supply. It's about 21 million Bitcoin, and there's about 16.5 million in circulation right now. The mining process and the reason, so these people that dedicate a large amount of computing power, which is expensive, to confirm transactions, and those are your nodes, they're rewarded through the mining process, which is basically that remainder. Right now it's about 4.5 million. It's already in existence, or per se, but we know what the end state is. There will never be more than about 21 million Bitcoin. But what that is it's coming into circulation through that process. So it's not a random process. Like you said, there's economic stimulus packages that we see now with centralized entities or centralized governments, and that's why things like Bitcoin, there's more proliferation there around cryptocurrency, because we have the benefit of living in a country like Canada where there's a lot of checks and balances, and our inflation rate is relatively stable, but that's not the case across a lot of the globe. So when you can guarantee the scarcity of an asset, or you know how much there will be and how much will actually be coming into existence through this mining process, then there's a lot more trust there that you're not going to get diluted by 50% because the currency that you have, the government decided to print twice as much money overnight to fund a political agenda.
Another international player is India. They've come out with currency, so the transactions are all done electronically, except for some of the small bills. But do you see any inroads of cryptocurrency in India?
We're seeing a lot of emerging markets, looking at cryptocurrency as an alternative or replacing their currencies. So I think what we're going to see is the emergence of government-sponsored cryptocurrencies in place of your traditional fiat currency. That India has been a leader in that as well. We're seeing, again, it's popular with emergent economies. If you go to Venezuela, for example, Bitcoin has taken off over the last 6 months, and predominantly because of, as you said, massive inflation, which is really hurting their people. So they've been able to use Bitcoin and other cryptocurrencies as a hedge against that type of inflation. And I think a lot of other countries are going to see that and take cues from that opportunity.
Two quick questions. How do you store your Bitcoins personally? And the second question is, what's your thoughts on Bitcoin Cash?
Yeah, I can start.
Okay.
I have a hardware wallet that I use, so it actually stores my private key. So with a wallet, you have a public key, which is something you could put that on a billboard. The only thing people can do with that is they could send you things, or they could use that and actually see your history of transactions, or through that hash, like what your public key type has engaged in transactions previously. And then you have your private key. Your private key is extremely important. That's like your PIN to your bank account. If someone got access to that, they can actually control your wallet. So I have my private key, and then you have an encrypted version of that, and I store that on a hardware wallet, which basically means it's offline. And then if I want to access my digital wallet, I actually use this hardware cold wallet to decrypt my private key, which I have a PIN and a passphrase that then decrypts my private key, and then I can access my wallet.
This is a challenge that we've been facing directly. As I said earlier, Randy and I have done really well in our crypto holdings over the last year or so, and so we were looking at how do we diversify and where do we store this stuff? How do we put it in a place that's actually accessible yet secure? One of the things we did is we diversified out of cryptocurrency into real estate. So we bought a hotel in Madeira Beach, Florida, which is essentially our safe haven. And then the profits of that hotel go back into cryptocurrency. But in terms of a business, we're running CoinLaunch, and CoinLaunch is going to launch tomorrow. And one of the things that was exciting yet terrifying was when our deal flow hit $1 billion last week. So in terms of opportunity, we're like, okay, this is going to be big. How are we going to manage all this income, which is all cryptocurrency based? So our business model is pretty simple actually. We take a piece of anything that's raised in the form of a cryptocurrency. So now let's hypothetically say the company does make $1 billion. We'd make some fraction of it, obviously, but let's just say it's $1 billion. And there's two things we have to work against. One is a very volatile currency. The currency in which we accept is called Ethereum or Ether, and that can fluctuate by 10, 15, 20% in a run of a day. It fluctuates 4 or 5% in a run of an hour. So hedging is going to be important. You can't run a business that loses 20% of its value in the run of a day, right? So one, where and how do we hedge against those sort of volatility aspects? Two, what if it gets hacked, right? That's a really big concern. I don't want to lose, a wallet that contains $100 million because we forgot to update some random thing on a server, right? So the diversification of a large amount of assets is going to be critical, and that diversification could happen across multiple wallets. Those could be, wallets that are software based. It could happen in form of sort of cold storage on a piece of hardware that's encrypted and sits inside a vault somewhere, which is probably the most secure. There's obviously environmental factors that could take place. What if the vault gets buried under a earthquake or burns the ground, or maybe there was a flaw in the actual hardware and you lose all your stuff. So there's challenges there as well. So I think ultimately the answer is in diversification of your holdings. So like anything, don't put all your assets in one place. You know, hardware is just one answer, multiple software wallets is another. I don't think there's been a good answer for folks who have large amounts of holdings at this point. And I hope someone does figure it out, but we're just spreading our risk across different things, whether it's different types of assets, both physical and virtual.
Wow. So I guess my answer to that would be in the context of the question for an average investor. So this is, we've got expert, kind of technologists here, right? So, and that's part of the challenge with cryptocurrency and investing in it. People are just overwhelmed by the information and what we've heard. So I'll dumb it down a little bit, because, from a practical point of view, if people are saying, how do I buy it? You can buy it with your credit card. You can use one of the main wallet exchanges. Coinbase is probably the most popular, not the most. They're not the cheapest, right? So if you're buying, a couple $100s or a couple $1,000s, it's a safe way to do that. Not until you're holding, millions and millions of dollars, you need to worry about basically, hard wallets and all the other stuff. So how does the average investor participate, get in? What are the risks? I would liken it to, we're all angels here, right? So cryptocurrency, I would argue, is no more risky than angel investing, right? You invest in a private company, regardless of all the governance and securities and compliance. If they make bad investments and they've got a bad management team, your money's gone, right? So I would say to the average investor, cryptocurrency investing is no more risky than startups. You don't put your life, your entire net worth, but you look at your portfolio. What part of your portfolio does that fit into? Is it 5%, 10%, 20%? Is an absolute dollar value. If you're worth $1 billion, you can put $100 million into it. So I would say, dollar cost averaging. It's never too late. It might be too late one day after, all bubbles burst, but I think it's here to stay. There's tremendous opportunity. So, and the other thing is de-risking. So as Reuven mentioned, diversification is key. So, when you're an angel investor, you don't put all your eggs in one basket. You don't write $1 million check for one opportunity. You write, 20, 50, 100K checks for, 10 to 20, 100 opportunities. So likewise with cryptocurrency, diversification is key. And then the other thing I think a lot of investors have a challenge with is, what is the underlying asset value? I just don't get it, right? So, you could argue that about money. What is the underlying asset value? So the US dollar used to be based on the gold standard up until I think it was 1974.
Looking at the oldest person in the room when he asked.
I was like a couple of years, I was still a baby then. But anyhow, so if you look at that, you can say, well, what is any currency? What is any asset? What is the value of it really, right? So there again, I think the biggest challenge and what Reuven and I are trying to solve with our platform is you can say cryptocurrencies, might be risky. Well, so is investing in a private company. Right? You could say, well, what is the underlying asset value? Well, for cryptocurrency, there again, when you're getting into ICOs, in our view and our vision forward is to say, let's make it, more mainstream by saying a cryptocurrency, if you fuse it with an underlying asset value, so being based on a gold standard. So I jumped into cryptocurrency because I like real estate. I like a tangible asset behind my, my asset, right? So with ICOs, the tangible asset would be if you're investing in a startup, you've got liquidity, you've got a smart contract, you're buying a future discount, you're buying a warrant. So when we do our pre-ICO and ICO, you'll get a substantial discount, which gives you instant gain. When you're buying a share of a hotel or a property, that's based on a cryptocurrency, that would be an ICO as well. Now you've got an underlying asset value. So I liken it to, if you look at like a REIT, for example, right? But REITs are not transparent. They tend to be below, and sorry if anybody runs a REIT here, but, there's a lot of, the big issues and the big challenges and the big problems that people are solving and that, cryptocurrency is solving is, number one, if you look at maybe I'm going a little off topic here, but if you look at the markets, right? It's been a challenge in the low interest rate environment that we've been in for a decade, for people that are, looking for income or fixed income that need that, right? People have substituted fixed income with real estate. Right? So I think in the future, people are going to substitute real estate with tokens. So ICOs that are based on a real estate or based on, priceless art or violins and whatnot. So I think the way of the future would be, having an underlying asset value as part of that smart contract, which is really going to open the doors for cryptocurrency and make it more mainstream. And people are going to love it.
Go ahead.
How many cryptocurrencies are there? How do they interrelate, and what's going to determine the success of one over another?
Yeah, so I think according to CoinMarketCap, there's about 1,200 cryptocurrencies as of today. By tomorrow, there might be 1,300. Not sure. And it's a good question. The kind of the interoperability between these 1,200 currencies, right? And if we see this rate of increase, all these projects are popping up. And I think it kind of gets back to what I was saying, that I do fundamentally believe there will be a consolidation. All of them solve, all of them claim to have a unique value proposition. I would say some of them definitely do, and a lot of the projects need a token underlying that to actually power whatever ecosystem they're developing. So for example, there's some where it's file storage and decentralized file storage. So, we have file storage is becoming more and more expensive. There's a lot of people with a lot of hardware space, like my mother, who's probably used 1 gig of her 120 gigs, whereas me, I'm going out and trying to buy extra hard drives to store this. And there's projects that are decentralizing file storage through the blockchain where you can put your computer up and then actually store people's files. So then you would need a way to actually have that value exchange. So that's one where they have a cryptocurrency. I can clearly see why they have a cryptocurrency, because people are being remitted funds for actually storing that file. That's just one example of many. And there's a lot of projects like that. But then there's some where they've launched a token and maybe they don't even actually have a platform yet, or it's very unclear. And I think some of those are the projects that will probably go to zero. In terms of the interoperability and how some of those move across, some of the tokens are powering larger ecosystems. For example, Kin and the project we've been working on, we view it as a general purpose cryptocurrency to be used across a lot of digital services. That's not always the case with every cryptocurrency, but also some of the things that was talked about in terms of diversification, or actually being able to. So then say you have stored these files and you've taken in some of that token, and now you want to use that on another platform that uses a different cryptocurrency. There are exchanges that you can go to, and you can actually just exchange those real time, like it would be, the stock market, or that's probably the closest proxy to how that kind of works.
Next question, go ahead.
Sorry.
Well, just building on that, why do each of these applications seem to need their own cryptocurrency fee? It's not, I think one of you raised the point that perhaps one or two of these will become global, like Ether or Bitcoin or something else. I mean, is there not going to be a point, or are these going to be ubiquitous, like almost like loyalty reward points, where different applications create their own currency? Which way is it going?
So just to make a distinction, there are two basic components here. There's a cryptocurrency, and those cryptocurrencies are based generally on a dedicated blockchain, right? They're their own sort of ecosystem and distributed network. Then there is a token. The token is often sort of mislabeled as a currency itself, but it's essentially a component that sort of sits on top of that currency. So, for example, on the CoinLaunch platform, we built ours on the Ethereum network, and the currency of the Ethereum network is based on Ether. And so what we've done is we've essentially created an abstraction on top that allows you to create sort of the contracts and the tokens. We call it coin because it's a little easier to sort of understand, but it's essentially sort of an abstraction on top. So now the question is, what does that abstraction on top, what does that token do for you? Each token can have different intrinsic value. So the goal for CoinLaunch, for example, is to create a CoinLaunch token. That CoinLaunch token can then be used to invest in other ICOs that are being made available on our platform. So those ICOs could run the gamut of different offerings. It could be a fractional component, as Randy said. It could be an ICO that says you own a piece of a corporate jet, and that token could maybe say 1 token equals 1 week of use of that fraction of that jet. Or it could be in the form of a timeshare. It says saying 100 tokens represent 1 night at a hotel. So these tokens can represent different forms of value within the context of how they're being offered.
It can be linked underneath to something like Ether.
And Ether provides the economic and transactional component. So each time you make a transaction using this token, the Ether, or in the case of the Ethereum network, is based on something called gas. Gas allows you to say how fast a transaction will happen. The more gas you spend, the faster the transaction happens, and so on. And that is a reward to the miners of the Ethereum network. So when you're saying, I want this contract to be deployed on the network, it goes to a miner. The miner does the transaction. They get a reward for doing that transaction. That's how the miner that's what they're mining. They're mining essentially transactions in the system. So there's a whole economy that gets defined through that. So again, back to your question, the token is changing the nature of value and value creation within the context of an organization. Yesterday we were having a conversation downtown in regards to sort of tokens in place of actual currency, and Apple being a perfect example. Why is it that we use $1 or €1 or any number of more than 24 different currencies to buy apps on the Apple Store? There's overhead of Forex. It's a fluctuating value of that Forex at any given moment. What makes more sense for Apple is to have an Apple coin or an Apple token that says this is our form of value, this is our form of purchase, and if you want to buy an app, it costs 1 Apple coin. In the future, our belief is that these tokens, these coins, whatever you want to call them, are going to be more linked to the value of a corporation or a company or even a nonprofit than they are to a government. And so again, Apple being a pretty good example. We think that there should be an Apple coin. Now the question becomes, how do they build that Apple coin? Hopefully they come to us. But
So I'm going to call an audible here. I want to give Tanner the opportunity to talk about the Kik launch, which is a real live one that just happened in the last 30 days. And then we're going to go into the coin launch demo.
And just before we do that, Larry, would you maybe set Tanner up just a smidge by talking about your involvement with Kik, what Kik is, and then over to Tanner?
Yeah, so Tanner and I met when he was actually setting up my purchase of kin in my house. And I invested in Kik as one of the earliest angel investors before Tanner was born. So,
And just for fun, who knows what Kik is? There you go, Statesville.
Tanner will tell you as well. It's a chat app, and it's interesting because it was originally going to be a streaming service for music and video, and pre-Hulu, and then the founders decided to write a chat app because they were having trouble getting the final agreement signed with the last license operator, and it took off in a crazy, crazy way. And it's been like that ever since. So Tanner was one of the co-op students out of Wilfrid Laurier that worked at Kik for Peter Henke, who is the COO and CFO. When Tanner was at Wilfrid Laurier, he was a linebacker on the Wilfrid Laurier football team. And for those of you that understand university football, you know that's a very good team. And he was the Rookie of the Year on that team. So when he graduated as an all-Canadian academic, he had already got his feet wet with Kik. So I'll stop talking and he'll start.
I appreciate the kind intro. Yeah, so I've been at Kik almost 4 years now, I guess, predominantly working with our CFO and COO. The how we got from Kik to Kin, and I'll give a little bit of a history. I know Larry did a good job of kind of giving an overview of Kik. It's a messaging service. The thing that makes Kik unique is that it's a chat community as opposed to just a chat utility. So, iMessage and WhatsApp, it serves the purpose of I can have these one-on-one conversations. It's great, it's fast, it's reliable. The interesting thing about Kik is what we see is that a lot of people that use it actually find and meet their friends on the platform. So people come and to Kik, they're spending almost 40 minutes per day, and they're participating in large community group chats, or also participating. We have a bot platform which we launched in 2014. We have over 100,000 developers that have built on top of the platform, creating about 200,000 experiences. So that's one of the things that makes Kik unique. And how do we go from Kik to now Kin, this cryptocurrency? And one thing that we've found is that it's very difficult to compete with some of these centralized entities. We're seeing a consolidation across the mobile space where a few centralized entities are controlling the flow of information as well as kind of the market. Facebook would be an example of that, where you have this one centralized entity building experiences for the masses, and it becomes increasingly difficult for other digital services to create experiences to sustain a business model. So this is something that we were finding had been difficult for Kik. We haven't been shy about the fact that we've had some challenges with growth in the past few years, and as we talk to a lot of other people in the industry, they're finding the same thing, where it's becoming increasingly difficult to compete on this model where you collect a lot of users and then you sell that attention to advertisers. And what was kind of the catalyst for us was about beginning of last year when Snapchat released its S1 for its public offering. You see this company that had over 2,000 employees, pre-IPO funding above $2 billion, and they're executing extremely well. But as they had this fundamental value proposition of stories, and Facebook comes along and they say, that's a great feature, we'll take that, we'll implement it into our platform. You see Snapchat's growth curve go from this to flat, and now they're one of the most shorted companies on the market. So we saw that everyone across the board is having this issue. And a cryptocurrency is a fundamentally new way to actually sustain a business, but also make everyone a stakeholder. We talk about Facebook. We as users go to Facebook and we use the platform. We can use it for free because Facebook's able to sell our attention to advertisers and then fund the operation of their business. But me as a user, I'm not a stakeholder in all of this value that I'm creating and the amount of attention I'm giving on the platform, as well as all the interactions and that data I'm providing. So cryptocurrency is interesting in that it makes everyone a stakeholder because you have this guaranteed scarcity of a supply, and anyone who has a part of that economy or part of that actual currency is now a stakeholder, and it economically aligns everyone to try and make the value of that economy greater. So the way that we've structured this ecosystem is that we took 10% and we sold that, which was what just concluded. Larry was a participant in that sale. So that's what, we just concluded that recently. That was about $100 million that was sold for 10%. 30% is retained by Kik, and then 60% goes to the Kin Foundation, which administers a rewards engine. And what the rewards engine does is it pays out a daily, takes the 60% and that vests on a declining basis, so 20% of whatever's remaining per year, distributed daily. And that's distributed daily pro rata to whichever digital services in the ecosystem outside of Kik are creating demand for the currency or transaction volume. So, me as a digital service, say I have 1,000 users, and on a traditional advertising-based model, I would never be able to get funding. I would never be able to sell those 1,000 users to an advertiser. But now, if I'm creating an experience where those 1,000 users are extremely engaged and they're exchanging the currency at a high rate, that's increasing the demand for the currency because I'm creating an environment where people want to use the currency, and with a fixed supply and increased demand, we know that the underlying value of each token increases. So now everyone in this ecosystem is economically aligned to try and increase the value of the economy, and it's not trying to take incremental amounts of that currency. It's actually trying to, everyone's economically aligned to just grow the value of the ecosystem. So that's kind of the short pitch on Kin, and why we believe it creates a fundamentally new way for innovation to happen. Because the other thing that we see is that if a centralized entity is controlling all of the development, you're going to get a lot of watered down services for the masses. This is an opportunity for people to build for those niche markets and actually sustain a business when they're developing these unique value propositions for these communities of users. So Kik will be the first to use Kin. We've implemented that and launched our first product where Kik users are now using Kin and have an opportunity to do that. And then very quickly we'll see other digital services come into this ecosystem, use Kin as a value exchange, and then you'll see this rewards engine start to pay out this daily reward to those digital services, which are creating opportunities to earn and spend, or two-sided marketplaces for users. Yes?
How will people economically benefit from Kin? I mean, how will they be able to buy anything with it, do anything with it?
Yeah, so, I mean, yeah, absolutely. So, I mean, we have an established value now of Kin after doing this sale. So we raised about $100 million for 10% of the currency. So now you have an attestable market cap, essentially implied market cap of $1 billion of these tokens. So you know how much each token is worth. You could, in theory, take that to an exchange. So as a developer, I've taken in part of this daily reward. I could take some of that, take it to exchange, and then so I could pay my bills, for example, or pay my employees, because right now, employees and bills are paid in U.S. Canadian dollars. So you can take that to exchange and do that. You could also reinvest that into your community through daily drop to your users to try and spur more growth in that ecosystem that you've developed. But as we start to see more and more of these experiences happen, for example, we ran a centralized currency on Kik for about 2.5 years called Kik Points, where users could earn and spend, and that wasn't decentralized. That was just within Kik, but users were able to buy movie tickets, for example, with that, because we were working with studios and some of these other ways. So you'll start to see as more digital services come into the ecosystem, there'll be more and more ways to earn and spend. So that's how you can get direct value, but you could also take it to an exchange and actually exchange that for dollars, because there is an attestable value for Kin to other currencies right now.